just know gold will bottom, well before the stock market does. So you'd be more likely to want to short gold sooner and catch the first little bit, and then maybe flip over to maybe doing some inverse plays on the stock market, because stock market can keep selling off for several months before, and gold will have already bottomed. And when gold bottoms first, just like I showed you on the gold chart, how gold has rallied first, when gold bottoms and starts to rally and the stock market's still going down, that's our early warning sign saying, okay, the global world is like the whole world as a whole is now realizing the stock market is now getting fairly valued or undervalued. They're actually moving. We're going to see people are still going to be panicking, and we're going to see the panic people moving into gold. We'll start to see signs that the stock market is actually starting to strengthen, even though it's going down. And so we can look at all kinds of internals, and gold will bounce first and bottom, and then the stock market. So we have leading indicators depending on what you're looking for.
Hey guys, my name is Danny and you're watching Capital Cosm. Today we've got Chris Vermeulen back on the show again. Chris, thanks for making the second time around.
Yeah, thanks for having me, Danny. It's a pleasure to be here.
Yeah, definitely. The pleasure is all on ours as well. Before we get started, guys, I'd like to remind you, hit that like and subscribe button if you haven't already. If you're getting value out of these videos, it goes a long way in helping us make more of these videos. Also, check out our Substack for additional content like this that you won't find here on YouTube. CapitalCosm.substack.com. Link is also down in the description box below. All right, Chris, let's just go ahead and dive right in. Let's get your macro view at first, and then we can kind of like hone in on specific topics as they come up. Yep. But front and center, what is top radar screen for you right now, Chris?
The top radar screen, I feel like we're in this major turning point I think in everyone's life, you got two or three major opportunities, major setbacks when it comes to financial, business, economy, and all that stuff. I mean, 2000 tech bubble was a huge wipeout and reset. The financial bubble in 2008 was another reset. COVID was an experience, but I don't think it was a financial reset. It kind of did some cleansing and did also a heck of a lot of damage to a lot of stuff, I think. But I think we're coming up to another major life kind of turning point for a lot of people. And I think people need to be aware that we could be going into a huge, what I call stage 4 financial reset, which is a bear market or a financial crisis. Everybody's got their own term for it. And the question is, are people going to be prepared for it? And I mean, last year I wrote a book called Asset Revesting, which is a strategy that allows us to kind of navigate the markets and benefit from all this in a very controlled, low volatility way. And I mean, that's part of the reason why I'm on trying to share insights on the market, because the market does a couple things really well. It knows how to apply the maximum pain to the largest group of investors at the worst possible time. And I believe like right now, it's like we have the most baby boomers, the most people with the most capital and close to retirement than ever before. And we are way overdue for a massive correction of probably 40, 50+%. We've seen it happen over and over again, 50+% corrections. People don't want to believe it. They don't want to hear about it. But I believe all the signs are there. And from a macro standpoint of what's going on in the economy, and sales are slowing, businesses are downgrading, unemployment's slowly starting to go up. We're seeing, especially unemployment in California in the tech space, it's starting to skyrocket. We've got delinquencies on credit cards. Not only are credit cards being delinquent, but we have like the highest amount of them fully maxed out, and then people don't want to pay. Where usually people just have a small balance and they're like, screw it. But I mean, we've got defaults on both commercial and residential. So there's a lot of stuff. And gold, precious metal, is one of the big warning signs telling us we are like months away potentially, or days away from a pretty big start of something ugly that is going to either wipe out your retirement, screw you over in some way. It's going to be super painful. So, I mean, that's the high level view, is like, buckle up. There's a perfect storm brewing. And I've been talking about it for a long time. It's kind of dragging its feet, but all the signs are here. And it doesn't matter when it happens. You just need to be ready for when it does happen. And that's the key.
Yeah, totally. So this 40-50% crash, what's its relationship with gold? Where does gold fit into all this? You mentioned the gold price potentially signaling something to that effect. Why is that?
Yeah, so if we take a look at the monthly chart of gold, so here's a really kind of good view of how the gold space kind of moves. I'm just going to zoom way out here. If we take a look at so there's super cycles in commodities, and we started a super cycle back in early 2000s. We started a new super cycle over here in 2019 for gold, and these are obviously very big patterns. Uh, so a few things. So once you've started a super cycle, usually you have a nice run. And if we go back to 2006, 2007, we had a multi-year pause in gold. After it had a nice run up, it had a multi-year pause. And that's kind of where we are now. We've had a nice run up. We've had a multi-year pause for gold. And while gold has been pausing, money has been piling into the stock market. So money is like either flowing into risk on assets, which everybody's piling into stocks. They're willing to take risk for big returns, or they move to a defensive asset like gold that doesn't pay dividends or anything. And so when gold is flat, the stock market is generally rallying and moving higher because people don't want to sit in gold. They want to go make money. So we have this very similar scenario. Now, what happened in 2007 is we saw gold break out of this and start to run. And there's all kinds of things happening. We have real estate bubbles. We have all kinds of PE ratios were out of whack. Things were overvalued. People are worried about currencies, stock market topping, real estate getting long in the teeth, meaning that bubble is coming to an end. And so people move out of all those assets and they start to move into gold. It's like it's its own asset, and it's outside of the financial system. And so when people get nervous, they move into gold. And this is an early warning sign. Gold is, to me, is the global barometer. It's not just what Americans and Canadians are doing. This is like the whole world is getting nervous. And when gold moves up like this, on its own, silver's not really following suit. Miners are not following suit. This is telling us we're getting close to a correction. And so we have been seeing that gold is on a tear. The world is getting nervous. We know there's bubbles everywhere. We're in a stage 3 topping phase, which we could potentially touch on later. I can show you some of that. But what happens after this is the stock market will roll over. We go into a recession. And doesn't matter what it is, almost every asset will pull back. Gold pulled back 34%. And I believe we could see gold eventually pull back 25 or 35%, right back down into this pause mode, this kind of consolidation level, which is equivalent about 30, 35% again. So that's the scenario of kind of what the world is doing, what gold tells us is kind of happening, how worried the world is, and the smart money. But gold is not like the safe haven play when we go into a recession. It will pull back. It might only pull back 25 or 35%, while the stock market might pull back 50% or 55, or growth stocks might pull back 60 or 70. But that's how I see gold unfolding and where we are in this overall cycle. And one other quick thing here, Danny, is if we use Fibonacci extension, which is my favorite tool, very accurate in terms of calculating where price should run. So you take a low, and then we take the high from 2011, and then we go to this low here. If we carry it forward, it tells us the momentum that gold had from this bullish leg up to its consolidation, to its pullback. My general rule is if gold or any asset, doesn't matter if it's gold or not, any asset comes up to the 618 level, which means that if it can rally 618%, and if it has a pause and pullback from that level, we almost always go up to the 100% measured move. So based on this run up here, the 100% measured move is the same measured momentum move to the upside. And so we have pretty much hit that. And that's where we are now. It's like, okay, this is the monthly chart. So every bar is 30 days, roughly 20 trading days. How many more bars do we have before gold breaks down? As you saw, it kind of took a year for gold to really break down. Now it did top right away, but it actually took like a year before it kind of broke that topping pattern and then went out of favor for a long time. So I think we're months, potentially a few months away this year, I think, from gold topping, the economy stalling, and all of that stuff. That's like my super high level basic view of things.
So I had I had another, I wouldn't call him a TA guy. He's kind of a hybrid, a guest on the show, and his philosophy was to not short gold, or not short gold, or not get in the way of a moving gold price as it's making new all-time highs. What do you think of that?
I don't think you should short it. I'm not a big fan of. So the only time I will short something, I don't really short anymore because shorting. Most people, I kind of do what's really easy. Most people don't short because their accounts don't even allow it. Most people don't realize you need a special privilege to sell short. If you sell short, you have unlimited risk. A stock can go up to infinity, which means technically you have unlimited risk, and people aren't comfortable with that. And of course, the brokers make sure you know it by giving you a special account saying, hey, you could like lose everything and more. I will buy an inverse ETF, but I will wait for a major market correction to take place. So for example, I kind of mentioned, we need a major reset, a stage 4 stock market reset. The stock market, if we take a look at this graph, there's 4 stages to a cycle for any asset class, not just the stock market. I believe we are in this stage 3 topping phase. So if you were to look at the equal weighted SP 500, the Russell 2000 and the microcap stocks, so we're talking a basket of thousands of stocks, they have the same chart pattern, a big blow off move, big crack to the downside, and a sideways move. You wouldn't see this if you look at the NASDAQ or the Dow or the SP 500 because they're heavy weighted with the Magnificent Seven that are doing all the heavy lifting. They're camouflaging the market. So people don't see what's actually happening under the hood unless they know how to lift the hood and know what they're looking for. So we're going back to your question, where would I short? Would I short? I will wait for the markets to sell off a lot. They need to probably drop 20+%. And then we're going to enter a stage 4 decline. And I have this chart green because as an investor or trader, we make money when there's strong trends. We don't care if it goes up, we can make money. We don't care if it goes down, we can make money. We just want a strong, definitive trend. So once we enter a stage 4, which is a long ways from where we are right now before it even starts to the downside, that's when I'll buy an inverse ETF because almost week after week, the market is bleeding lower and lower. And if gold is also selling off and it's in a downtrend, then you could potentially sell short or buy an inverse ETF on gold. Just know gold will bottom, well before the stock market does. So you'd be more likely to want to short gold sooner and catch the first little bit and then maybe flip over to maybe doing some inverse plays on the stock market because stock market can keep selling off for several months before, and gold will have already bottomed. And when gold bottoms first, just like I showed you on the gold chart, how gold has rallied first, when gold bottoms and starts to rally and the stock market's still going down, that's our early warning sign saying, okay, the global world is like the whole world as a whole is now realizing the stock market is now getting fairly valued or undervalued. They're actually moving. We're going to see people are still going to be panicking. And we're going to see the panic people moving into gold. We'll start to see signs that the stock market is actually starting to strengthen, even though it's going down. And so we can look at all kinds of internals. And gold will bounce first and bottom, and then the stock market. So we have leading indicators depending on what you're looking for.
And what do you say to people who just have this kind of crash fatigue? Let's call it. There's tons of people who've been calling for a crash for a while now, but the market keeps making new all-time highs. Gold is at an all-time high. The momentum doesn't appear to be slowing down by way of gold. So what do you say to those people?
Yeah, I've been calling for a top for a long time. I think I see one coming. The question is, when is it going to come? And I think the mindset has to shift a bit for people. Is just because the signs are there and we're expecting it and we're calling it top, we still have to wait for it to happen. Unless you're a bottom and top picker, which is a great way to lose a lot of money, you just have to wait. And so what we have to wait for is gold to finish. You're 100% right. Gold is still in a very strong rally. It could keep going. I'm just saying from a long-term standpoint, we have hit that threshold that we should start to see volatility, meaning it's going to start to rally and sell off. We could see some big selling volume days in gold. What we need to see is a very strong reversal type of candlestick bar or a chart pattern, big volume to the downside. We need to start to see those things happen. But you're right, gold right now is on a tear. I would not be shorting it by any means. I don't care if I think it's going to fall 35% from here. It's in an uptrend. You don't fight the trend. You wait till it reverses. And we can call a top all we want, but it's not going to happen until it actually does it itself. So it's just being mentally prepared that I think we're close. And then you have to wait for the technicals and the price to actually turn over, roll over before you take action. But people want to like front run it. They want to buy it, sell the high, and they want to, there's so much satisfaction if you do it, but it's like a serious hit of dopamine when you nail it. But it really ruins you as a trader because it doesn't happen very often that you can nail a top or a bottom.
Hey guys, quick pause. If you're enjoying this content and this channel as a whole, but want to take the experience up a notch, then consider joining Capitalcosm Club here on Substack. You get access to exclusive portions of my interviews that you won't find on YouTube. You'll have the opportunity to ask my upcoming guests a question. You'll also get the chance to recommend me guests. You'll get a chance to DM me. My DMs are open on Substack for paying members only. Talk about whatever you want to talk about. And we also do market write-ups. And with that said, I'll let you get back to the video. Thanks, guys.
What would get you to change your call, Chris? What confluence of evidence would kind of sway you the other way?
I mean, are you talking for equities or gold or?
Let's talk about both.
Okay, I think if we start to see big money flow back into a lot of growth stocks, like a good example is like the ARK ETFs, like they're all high growth. I mean, they've all been nailed like 70+%. They've recovered and they're all building a base. We just haven't seen the small cap and the micro cap penny stocks. They haven't really come to life. When those start to come to life and we actually see big money flows in those, that's when there's like real people are willing to go like full on risk on. Like they're willing to like lose a lot because they're really volatile. We just don't see any life in those. I don't want to see the stock market making new highs with 7 stocks or 1 stock doing all the heavy lifting. Like that's not a sign of strength, right? So I would like to see the majority of stocks as a whole, like potentially like the blend of the SP 500 equal weighted ETF, the IWM, which is the Russell 2000, and IWC, the microcaps. You blend them together. I like to see that hitting new all-time highs. That tells us, okay, on average, stocks are now making a new all-time high, which they're not at this point. It's just the Magnificent Seven dragging the indexes up. So if we do see money flowing into the majority of stocks, and most sectors are near highs or making new highs, that'll totally change the view. It'll be like, holy cow, this market may have fully reset, and maybe we're going for a new leg up. And I mean, that's the nice thing about technical analysis and having risk and position management in place is we can identify when we're in a super strong trend, when we're bullish or bearish. And, to pull up a chart to give you a visual here, let me just show you a weekly chart of the SP 500. So I think you and I might have talked about this last time, is how I look at the stock market like the ocean. When the tide goes up, it lifts all boats. When it goes down, they all go down. So the stock market is the same. This is the SP 500, SPY ETF, the weekly chart. And we want to identify when the tide is going up. Are we in a bullish environment? Are we in a bearish environment? Understanding these tides. So we're still in a long-term uptrend, and it's very strong at this point. I mean, price-wise, it's strong. There's a lot of things breaking down. It's lost a lot of momentum. In fact, where we are right here, we have the same technical setup and momentum as we had back over here. So it's a very sketchy time in the market right now. Which way is it going to go? Are we going to have like a blow off move, or is it actually going to crumble and start a deeper correction? So, I mean, I want to see, like right now, the nice thing about technical analysis and your question of like, what would change my mind is technically we're still long the market. And until our charts and the trend reverse, I am bullish. This is the crazy thing. I'm talking super bearish because I'm trying to warn people that there's something dangerous is coming, but we are long the markets. We are bullish. You just need to know, you need a plan in place for when something really big and nasty happens, right? So that's the reality of it. What I say is what I think is going to happen. It doesn't mean that's my position. I'm not betting on falling prices right now. We are betting on a long market. And if you follow the trends, then you're gonna be riding them up when they're in place, and when they roll over, you're not going to be in them. That's the beauty of following. I don't predict, I follow, so I don't have to do much other than just ride the coattails of the market. And that's a big change, is people don't want to follow, they want to like predict, and they want to try and maximize the returns, but that's the very hard way to make money in the markets. You have to sit back, ride the major trends, play the shorter term trends with more active trades if you want. But that's how I go about it.
What's the biggest piece of advice you give to, aspiring TA analysts out there?
Um, I think a big part of it is really position and risk management. And nobody ever like I used to sell a course on position and risk management, and nobody buys it. Nobody bought it. It's such a boring topic. People literally, when they put a position on, they're like, they look at their account, how much money they have left in cash or whatever, and they're like, I'll put 25K in this one and put 10,000 in this, like random amounts. They don't actually like say, okay, if I put 25K in this and it's my say it's a $100,000 account, if I lose 20% of that, it's going to actually take a huge chunk out of my account. It's going to knock my account down way more than 1% or 2%. It's going to hurt. But people just put in these random chunks. So I would say as a TA, find a way to follow trends, whether it's weekly or a daily chart. Follow trends as closely as you can. How can you identify when a trend has changed direction so you know when to switch positions? So wait for the trend to confirm. You're not going to get in, like, for example, this is a big thing that people need to grasp. And you had a really good question there is we have, grab a marker. The market topped up here. The market trend changed here. You're not going to get out of the top. You're going to have to give back gains. And when the trend bottoms, you're not going to get into later. You're going to miss out on those gains of the potential rally or the potential pullback. You have to realize it's about catching, these middle sections. You're really just trying to catch this section, but it's dragged out over going up. And then people are like, oh, I gave back so many gains. And they get out here. They're like, why did we give back so many gains? You have to put in that time. You have to watch your account go up a bunch, and then you're going to have to watch it give back before. If you try to get out early, you don't know when the top is, and it could just keep going up and up and up. And then you're like, I got out, and I missed the whole next move. So that was one point. I can't remember what the other point was. So follow a trend as close as you can. Oh yeah, and then manage your position. Figure out how much for that particular asset. If it moves 20% all the time, like Bitcoin or something crazy like that, you need a much smaller position. If you're putting on a huge portfolio of that, you're carrying huge risk. And to me, that just says you don't care if you lose 20% of your account, in a day and a half, because you can wake up and Bitcoin's up or down 10 or 20%. So it just comes down to position sizing and understanding how much risk each position has. The more risk, the smaller your portfolio it should be.
Gotcha. We covered gold in the markets. Let's go ahead and expand out on silver. Silver's had a pretty good year as well, up to 31.41 on your chart there.
Yep.
What do you make of silver's current action?
Yeah, I think silver has a bit more upside potential. I mean, we've got these lows down through here. We've had this rally, and I love to use Fibonacci extensions for momentum. And more or less, we've seen silver. It had a run up, it had a pullback, it hit the 618, it's paused, it's chopping there, and I believe we're going to go up to 34 or so for silver. I still think gold can run up to 2750, I think, fairly easily. I think silver is going to play catch up here and pop. I think we could see silver run to 34, 35, which brings us right into these previous highs. So not only is it a measured move saying that's where it should naturally run out of upward momentum, but it's also a very significant resistance area on the monthly chart. Not only did we have, it's hard to see on this chart, but we had a couple candle lows right through here on the monthly chart. We have 2 candle highs here, 2 more candle highs. You could say 2 or 3 candle highs here. So this blue line, this measured move, if silver hits 34, 35, just like, gold hitting that big measured move, I think most of the move is done. I would expect selling and for it to pull back. And, silver pulls back a lot. In 2008, everybody moves precious metals as a safe haven play, but they don't realize, it falls over, silver fell over 60%, more, twice as much as gold pretty much. So precious metals are seen as a safe haven, but they're not actually a safe haven during times when you actually really need them. And people think the same with large cap, like blue chip stocks. You go look the dividend paying ETFs, the dividend stocks during COVID, dividend stocks sold off way more than the stock market did. And that's because the same group of investors, all the retirees, all the big money, they are all put into the same things. And when that same school of fish all panic, they're all selling the same shares. And so dividend stocks get hit even harder. And utility stocks get hammered as well. People think these are safe haven plays. They're safe haven plays short term, just before a market sell off, they can do really well and hold their value. But once the sell off starts, you're holding actually more volatile positions than just owning the indexes outright. It's crazy how backwards and advisors like push people into all of these plays, all because they can say, oh, you get dividends. And it's like, I don't care if I make 5%. If I'm going to give back, 50% of it or more in these stocks, I'd rather just buy it back later. I don't care about dividends. It's, when you go into a bear market, buy it later. The dividends will be higher and you can buy the shares at a fraction of the price. So, so back to silver. Silver has got more upside. It's got about 10%, I think, from where we are right now.
Okay, so that takes us to about what, $34, $35?
Yep. 34.75, somewhere in that range.
So, Chris, do you forecast out long term wise? So, you are forecasting this crash that's that's taking form, but outside of that, like further out in time, how do you see the gold price coming out ahead? Do you see us continuing this uptrend, this secular bull market in gold?
Yeah, good question. So actually, let me pull my chart back up. I'll show you kind of, if I was to draw out what I think the perfect scenario for gold would be, I would come back here and more or less, I believe we're going to have a financial reset. So I believe gold is going to pull back somewhere down into this range, 2000, 1900, somewhere in there, 1800 even. And then once we've had that reset and the financial markets have sold off, housing market is starting to decouple, which is on the verge of a massive collapse itself. Anyway, once we see gold and the market's correct, if this happens, to me, this is like the ultimate opportunity. This is something like really we were waiting for back over here. If you ever caught the gold miners run and gold back in here, it was epic. Right over here was absolutely game changing in terms of building wealth and excitement and like hundreds or thousands of percents on stocks in the gold and silver space. This opportunity over here and the one down at the bottom here is this. And I believe like this is where gold will be like, we'll start that next 4, 5, 6 year rally. And this time it could be a whole lot bigger percentage wise. You could be $3,000, $4,000, $5,000 very easily. Simply because I think we have a lot going on with the debt problem and, fiat currencies generally always blow up over time. I feel like we're getting closer and closer to that. And, we got currencies all over the place and Japan currency and people are wanting to come out with different digital currencies, gold-backed currencies. So how much longer does the dollar have? And if you look at gold and dollar standpoint, I mean, gold could really take off terms of the dollar. So it'll be interesting, but I'm picturing a sharp pullback in gold and silver. And then that's like back the truck up, load up for opportunities. And that's when I'll be really focusing on it with even my followers and subscribers. We're all big gold bugs. And when this perfect storm scenario happens and we see the signs that a bottom is there in the precious metal space and uranium space, we'll be really focusing on that for a chunk of our portfolio for some outsized gains.
What about uranium? What's your take on uranium?
It's pretty much the same. I mean, I'll just pull up the URA ETF, which is kind of the overall basket. I mean, uranium stocks have been out of favor forever. They finally have come into favor in the last few years. They built a giant base. I do think when the stock market and things correct, these are going to get hit really hard. They're volatile already. I think everything is going to pull back, like I talked about before. When the tide goes down, these are going to get pulled down. And the key is, to me, is waiting for these perfect storms to brew, and then you can get very active and aggressive in them. But I don't believe we're in that perfect storm yet. I think we're still many, many months, maybe even a year away before all this unwinds. The big question is, do we have a financial like a 2008 financial crisis? It happens like within a year, a 1 year window, or is it going to drag out like the tech bubble? It takes like 3 years of falling and falling prices. Just how quick is this going to happen, right? That's the big question. And while we see like a big correction, or I see a correction coming, I don't know if it's going to be like a flash crash and it wipes the slate clean in 3 or 6 or 8 months, or if it's going to take multiple years. And depending on how it falls will allow us to start to get a gauge of like, holy cow, this is going so fast. We might actually bottom, in a few quarters versus, 3 years from now. And once we see how fast things are liquidating and falling, that'll probably be our gauge of when this, I think uranium stocks could become a really good opportunity along with metals and miners and stuff. But I think these are going to be to the moon. I think uranium stocks have got tons of potential. Nuclear energy, I think, is going to be huge. The whole world is electrical and vehicles, and nuclear is like the way to get the power. And it's pretty clean the way they can do it, and pretty safe these days. So,
is there a safe haven, I guess, in the event of this crash that's coming, or is it simply cash?
I mean, cash is king when everything's falling. I think there could be potential to go into the US dollar currency. I think if you held US dollars, which I hold a lot of, I keep everything in the US dollar. I still think the dollar has one more big leg up, the dollar index. So I'm in Canada, so I want to play that. I want to take advantage of a strengthening dollar. Now, if you're American and it might not make much, you're already in it, so it doesn't really matter. But as a foreigner, I want to hold U.S. dollars. I've held them for years, and I mean, we're up like 34 or 35% just from holding U.S. dollars versus Canadian dollars. So it makes a big difference. But other than holding U.S. dollars, I mean, just sidestepping and sitting in cash, keeping your wealth. You don't have to make money when everything falls apart. But if you can keep your money and just keep your current state of wealth, once the market resets, you'll have the same wealth you had a year ago that you can say, okay, I don't care if the inflation ate into a little bit. That really doesn't make a difference. But now I have my current standard of living, my wealth, and now everything's affordable. I can go buy just the stocks I like cheaper. I can go buy investment real estate. I can start a business now because the cycle's cleansed. Everything's affordable. So cash is king. There's no doubt. People just for some reason think they always have to be in something, and they don't see cash as a position. And when everything is falling, cash is a bloody position, but people don't want to accept it. They're like, I don't waste my time in cash. Inflation's going to get me. I'm like, to me, it's the wrong mindset. It's preserve your capital, preserve your wealth, your lifestyle. And when the opportunities come, I mean, I don't want to be in cash either. I want to be in something moving, but I would like to maintain what I have and have the gunpowder, the same amount of gunpowder ready for when there's a new opportunity.
Excellent. Where can people find you, Chris?
Yeah, they can find me thetechnicaltraders.com or YouTube at The Technical Traders. And I share videos and analysis of what I'm doing. And pretty much everything I trade with I manage my own money, and then I share my trades, exact trades and portfolio allocations, all that stuff for you to copy. So we can all invest and trade this stuff together as a community. That's what I do.
Excellent. We'll have the link to all those down below, so be sure to check them out, guys. And if you enjoyed this content, thank you so much for watching, and hit that like and subscribe for more content like this. Also, check out our Substack for the rest of this interview here with Chris. And Chris, thank you so much for coming on, my friend.
Thanks, Danny. Pleasure. Always great questions. I love it.
Yep. All right, guys. I'll catch you next episode. Bye, y'all.
If there's less products being shipped in container loads and products being sold, there's less things that get shipped around, we're going to have less demand for oil, and people are going to tighten up on their pocketbooks. Less products being made. A lot of products use oil. So I'm really bearish on oil. Like, I've been bearish on pretty much everything at this point. I don't think there's a whole lot of upside. Oil might have a little bit of a bounce, but long term it's in a downtrend. Short term it's in a downtrend. It's on the verge of breaking down. And I see $55, a barrel